So this is a basic video all about sales and purchase ledger control accounts. And I'll also record some videos going through past exam questions, but I'll do those separately. So just a bit of revision, a little recap on individual ledger accounts. So previously we've learned how to record transactions in those journals, the books of prime entry, things like the sales journal, purchases journal, also the cash book, the general journal, and the returns journals, and then transfer those into the individual ledger accounts in the sales and purchase ledgers, and also into the nominal ledger accounts, or the main ledger, general ledger, whatever you want to call it. Doing the double entry from those books of prime entry. So remember that the sales and the purchase ledgers only contain named accounts. So in the purchase ledger, it's the named accounts of suppliers. In the sales ledger, it's the named accounts of credit customers. So credit customers, credit suppliers are contained in those ledgers. And this is just a reminder of the entire accounting system. So if you remember, we start with source documents. Those are the bits of paper listed here, most of them, that document transactions that have happened to the business. So sales invoices, when we send those to customers when they bought goods on credit, credit notes when they return goods to us, purchase invoices when we buy stuff from suppliers, credit notes that suppliers have issued to us because we've returned goods, general bills, check stubs, receipts, paying in slip, remittances, that kind of thing. So all of those source documents are then entered into these subsidiary books or books of prime entry. So the sales invoices go into the sales journal. The credit notes that we've the credit notes that we've sent to customers go into the sales returns journal, purchase invoices into the purchases journal, and credit notes received from suppliers into the purchase returns journal. Any bills that we've paid, checks that we've written, receipts, money that we've had in either by bank transfer, checks that we've received, cash that we've received, paid into the bank, all goes into the cash book. And then the general journal, remember, we have that for our non-routine transactions. So we complete the double entry with the sales journal, we tally up the total sales for the month and we credit that off to the sales account, the sales revenue account, and then we debit the individual customer accounts. We do the same with purchases. We total up the amount of purchases bought during a month, debit that to the purchases account, and then credit, all the individual supplier accounts in the purchase ledger. So those ledgers, just a reminder, then we've got the three ledgers plus the cash book, which kind of acts as its own double entry. Obviously, the cash book is contained under the umbrella of the general or nominal ledger. So sales ledger, just the accounts of credit customers. Purchase ledger, just the account of credit suppliers. Okay, and then all of those accounts will feature on the trial balance and then ultimately in the final accounts. Okay, so if we have a quick look here at a credit customer's account, so this is a trade receivable, this is an individual account, someone called M. Owen, he or she owed the business on the 1st of June, £5,000. So remember, with customers, it's a trade receivable. If you remember the Dear Clip mnemonic, on the debit side, it's drawings, expenses, assets, and receivables. So trade receivables always open on the debit side, unless they've overpaid us for some reason. So very occasionally, you may have a trade receivable with a credit balance, but that is not the norm. So we start with the opening balance on the debit side. Anything that increases that balance will go on the debit side. So if we sell goods to them, or they bounce a check on us, so dishonoured checks is probably something else that could go in on this debit side, and that goes in. So selling goods to them, we're crediting the sales account, debiting the customer's account. Anything that reduces the amount owed to us goes on the credit side. So sales returns, money that they've paid us, and then the BAL CD, in this case £3,000, which comes forward on the 1st of July as an opening balance. So it says other transactions could include discounts allowed. So if we allow discounts to our customers, they would go in on the credit side. It's a cost to us, so we debit the discount allowed account, credit the customer. What else have we got down here? Contra entry. So a contra is an entry between the sales and purchase ledger. So this is where we've got someone who's a customer and also a supplier. So we credit the customer account in the sales ledger and we debit the supplier account in the purchase ledger. So that has the effect of reducing both balances. Irrecoverable debts. So if we had decided that this MON had gone bankrupt and we had to write that off, we would credit the MON account with £3,000 here and debit irrecoverable debts on the income statement. Other things, I mentioned the dishonoured check. So if a customer bounced a check on us, so if this £4,000 here bounced, we would have to bring that back in on the debit side because it would bounce back into our bank account as a payment. So we'd credit the bank and debit the customer's account to reinstate the amount they owed. And also any associated discount allowed. So if when they paid us this £4,000, we'd allowed them any discount, that would also need to be reversed out. So we'd be crediting the discount allowed account and debiting the customer, because we're not going to allow them discount if they've bounced a cheque on us. Okay, if we do the same with the credit supplier, so remembering the Dear Clip mnemonic, credit suppliers, trade payables, the balance is always brought down on the credit side unless for some reason we've overpaid them. But the norm is to have a balance brought down on the credit side, and it's the P in clip. So remember, on the clip side, it's capital, liabilities, income, and trade payables. So anything that increases the amount we owe to, in this case, our Gupta, would go in on the credit side. So the obvious one there is purchases, debit purchases, credit the supplier's account. Anything that reduces the amount we owe to our Gupta in this case would be on the debit side. So if we pay them, in this case we've paid them £4,000, we're going to credit the bank and debit the our Gupta account. Purchase returns, credit purchase returns, and debit the supplier account to reduce the amount owed. And then, like with everything else, balance it off and then bring that balance down at the 1st of July, in this case, £1,000 on the credit side. And again, discount received. So if we've received discount, it will be on the same side as the bank payments we've made to the supplier. So discount received is a type of income, credit the discount received account and debit the supplier. And then contra entries, as I mentioned before, are always debited to the supplier account, credited to the customer account. Okay, so now we can start looking at these master accounts. So the sales ledger control account is a master account for the sales or the receivables ledger. It's what we call a memorandum account. It sits outside the basic double entry in the case of the A-level syllabus. The purchase ledger control account does exactly the same, but for the purchases or the payables ledger. So these control accounts summarise the transactions that have gone on in the individual memorandum accounts. Now, the way it works is that when we make the double entry, we are debiting and crediting between the individual accounts of the suppliers, of the customers, and then the relevant non-nominal ledger accounts such as sales, purchases, returns, that kind of thing. Now, what the control account does is take the totals from those books of prime entry. So the total for sales, the total for purchases, it looks at the cash book for the total amounts received from customers or paid to suppliers during the period, usually a month, and it assembles these control accounts. So the idea being it's kind of double checking the arithmetic, and we'll see how that works in a little while. So sources of information, as I said, the sales returns, purchases and purchases returns are going to come from the journals, from the sales journal, sales returns journal, and so on. Receipts from credit customers and payments to suppliers are going to come from the cash book, as are any discounts allowed or received. Remember, we have 3 columns in the cash book. We have bank and cash, but we also have a column on each side for discounts. So discounts allowed on the debit side to customers and discounts received on the credit side from suppliers. Dishonoured checks will also be found in the cash book. So if someone's bounced a cheque on us, that will be found in the payment side of the cash book. And then non-routine transactions. So if we've written off any irrecoverable debts or we've made any contra entries between the sales and purchases ledgers, then those will be found in the general journal. Okay, so this is what a sales ledger control account looks like, and it really isn't too complicated as long as you can get your head around the idea that we're just assembling this from the totals from those books of prime entry, so not adding up all the individual transactions that have happened. And this is just a double check, as I mentioned before. It sits outside the basic double entry, and it will help identify the presence of errors, so particularly those roux errors where they're one-sided, so a partial reversal, a partial omission, or a partial error of original entry. Quite a tongue twister. So it will identify those, because when we do this sales ledger control account, we come to a balance carried down at the very end, which should equate to the total of all the individual sales ledger accounts if we add those up. Now, if there's a difference between what's on the sales ledger control account and the total of the individual receivables accounts in this case, then we know for sure that there's an error. It's not going to help us find that error, but it will, like the trial balance does, notify us that there are some errors present. Okay, so the way it works is we start with the balance brought down. So remember that with receivables, it's always going to be a debit balance overall. Very occasionally, you might have a situation where there's credit balances brought forward. Now, in real life, you would net those off against the overall debit balances, but for some reason, in the world of exams, they often show them as a separate entity, so any credit balances would be on the credit side. Sales, so we're going to pick that figure up from the sales journal. So that's going to be, usually this will be prepared for a month at a time. Every month we'll reconcile the control account to the individual balances by doing this. So we're picking up the sales, that's the total for the month from the sales journal. Sales returns on the other side, so we're going to pick that up from the sales returns journal, pop that in. Any money we've received from our trade receivables, that could be via bank or cash, but they have to be receipts from trade receivables. Cash sales are never going to be included in this control account. We are only controlling the credit transactions, so they go in on the credit side. Any irrecoverable debts, so anything we've decided to write off, we'll pick that up from the general journal. Any discounts allowed to our customers will be from the cash book, so that'll be the total for the month in there. Any contra entries with our purchase ledger, credit the sales ledger control account, we'll be finding those entries in the general journal. And the one I didn't mention over here, dishonoured checks. So this is the bounced check situation where a customer has sent us a check. We've paid it into the bank, so we debited bank, credited the customer, and they bounced the check on us. So we now have to credit the bank, debit the customer. So we'll pick those up from the cash book. Then we, just like with any other T account, balance it off. So we have a balance carried down and a balance brought down, which again is always going to be on the debit side. Trade receivables are a current asset. Okay. And what we're going to try and do is reconcile that to the total of all the individual sales ledger accounts. So we'll make a list of all the customers who owed us money at the end of the month. And if the two figures agree, so if our list of customers who owed us money equals the total on this control account, then we know that overall things are going to be pretty okay. So we know that the total for trade receivables is correct. There may still be some errors hidden. I'll talk about those in a little while, but we might still have an error of total omission where we've forgotten to include a sales invoice right at the beginning in the sales journal, and that's going to be missed out all the way through. So the sales ledger control account isn't going to notify us of that, but it will tell us, problems like if we'd added up the sales journal wrong. So if we've got the wrong amount there, then our control account is not going to agree with the total of the individual customer balances. Okay, so over onto the purchase ledger control account then. This time the balance is brought down on the credit side because it's trade payables, the total there, so they're a current liability. Anything that increases those is added into the credit side, so purchases, which we're picking up from the purchases journal. And if we've had the audacity to bounce a check on one of our suppliers, or perhaps just write one off because it's been lost in the post, then that's going to be coming back in on the credit side, together with any discount that we might have received with that payment. On the debit side, anything that reduces the amount we owe to suppliers, so purchase returns, picking that up from the purchases returns journal. Discount received, we're going to get that out of the cash book. Payments to trade payables, also out of the cash book. And any contras with our sales ledger, we'll find those in the general journal. So that's going to be in there. If we had to write off any balances for another reason, I don't know, we're not going to get irrecoverable debts with the purchase ledger, but maybe we've written off a balance. Maybe the supplier has gone bankrupt and nobody's chased us for payment. Then that would come in on the debit side. The only other thing we might see is interest charged by our suppliers. So if we're late paying, then we might get interest charged on our suppliers, and that's going to be on the credit side. It's an expense, so we'll debit interest paid. That will be an expense on the income statement, and we'll credit this purchase ledger control account to increase the amount we owe to our suppliers. And again, we balance it all off. At the end of the month, we bring down the balance at the start of the next month, and that balance brought down should agree to our list of individual suppliers and the total amounts that we owe to them. If it does, great. There might still be an error of commission in there. We might have posted something to the wrong person's account, wrong supplier's account, but overall that balance for trade payables should be correct. If it is different, then we know that there are errors, and we're going to have to check all of these numbers out to try and find those errors. And the errors could be contained within these books of prime entry, or they could be contained within the individual accounts. Something might have been added up incorrectly there, or we might have missed out one of our accounts from our list. Any number of errors could have cropped up. So again, it will notify us to the presence of errors if the two figures are different, but it won't tell us exactly where we can locate those errors. We have to do that ourselves. So the reconciliation, I've already mentioned this, at regular intervals, usually monthly, the customer and the supplier balances from the individual accounts are totaled. So that's just simply a case of making a list of all the customers, of all the suppliers, how much you owe to the suppliers, how much the customers owe to you, and then totaling them up. And the closing balance on the control accounts should agree with the relevant total of the closing balances on all the individual accounts. If they do, as I said, great. If they don't, then there are errors. present. So the trial balance, just to mention that, the closing balance on that control account can be taken off to trade receivables on the trial balance, and the closing balance on that purchase ledger control account is going to be shown on the trial balance as trade payables. So that's provided we've reconciled it, so we should do the control accounts prior to assembling our trial balance, just to make sure that the figures are correct there. Okay, so other points to note. It sounds really obvious, but entries in the control accounts are on the same side as you'd find them on the individual accounts. Cash sales and purchases are never included in the control accounts. If they're given to you in an exam question, they are what we call red herrings. It's a false friend. You should ignore them completely. So sometimes the examiner is a little bit crafty, and they might include figures that you don't need, just to see whether you can discriminate between things you do need, things you don't need. But if you get cash sales, cash purchases given to you, please just ignore them. They have no place in a control account. Okay, the double entry, I mentioned this earlier, but it's with the entries in the individual sales and purchase ledger accounts. The control accounts are merely memorandum accounts, and they just summarise the transactions and double check the arithmetic to make sure that there aren't any errors. So it's a bit like the trial balance. The trial balance itself isn't part of the double entry. It's just double checking that the debits and credits agree. Something like the bank reconciliation, it's proving why there's a difference or explaining why there's a difference between the cash book balance and the bank statement balance. It isn't part of the double entry itself, although the cash book obviously is. And then a set-off or contra, just a reminder about that, exists where a customer is also a supplier. And the contra entry, if you're ever struggling, it's always entered on the same side as the bank receipts for the sales ledger and the bank payments for the purchase ledger. It always reduces the amount owed. So always credit the customer, debit the supplier. Okay. So why do we do these control accounts? And well, hopefully you have an idea, but it does, one of the advantages with them is it gives immediate up-to-date information on the total of trade receivables and trade payables. So if you need to know those figures in a hurry, perhaps because you're preparing some interim accounts, some management accounts, then you can find those figures quickly by preparing a control account. It should make fraud more difficult, particularly if there's segregation of duties. If somebody has falsely updated a customer's balance with some cash that they paid, and the cash has been stolen, there's going to be no record of that in the cash book. So we should find that there's a difference between the balances. So fraud and theft should be made more difficult. Should help to identify the presence of those one-sided row errors, but it's not going to tell us where those errors are located. So remember that errors of total omission, total reversal of entries, or original entry will remain undetected. So if you write the amount down incorrectly at the start in the sales journal, it's going to be wrong all the way through. And it can assist with the preparation of final accounts, particularly if full double entry records are not kept. And this is something you'll get onto in the second year of your studies when you do incomplete records. I know it's hard to believe, but some clients won't keep proper books of account. They won't prepare double entry records. So it's your job to be a bit of a detective and try and find missing figures. And one of the ways you can find a missing sales or purchase figure quite easily is to prepare a control account. Okay, so I'm not going to go through any more detail here. That's just giving you an overview of it. But if you want to look up some questions and have a go, in the latest specification, the old AS paper, there was one question that came up. It was question 13 in the 7126 June 2020 paper. So 7126 is the old AS specification. It's been discontinued now due to lack of interest, but there are still some papers out there that might be useful material. So this is quite a straightforward question in terms of producing sales and purchase ledger control accounts from a list of balances. I don't think there were any red herrings in that one, but you have got an error and an adjustment to consider there. So hopefully I might get a chance to record a video on how to do that one. So look for that separately. D. Lewin was one that came from the paper 1, so 71271 in June 2019. It was question 12. So this was where you had to do just really quite straightforward purchase and sales ledger control accounts from a list of balances. And there weren't any red herrings or adjustments. So they hadn't thrown cash sales or purchases in there, and they hadn't identified any errors. And if you want to look back at some of the old specifications, so the ACCN 1 papers is where you'll find control account questions. So I've just suggested a few here. June 2016, there was a question called Samuel Cole, quite a straightforward one. Depeche Palmer in June 2012. you had, this was quite an unusual one, they gave you the totals from all of the books of prime entry, and they might talk about like the sales day book, the sales returns day book. It's the same as journals, it's just old terminology, and the cash book. So you had to assemble your sales ledger control account from those journals, those day books. And I think, if I remember correctly, there are a few red herrings in there. They might have given you some stuff that was to do with purchases, just to check that you didn't just try and throw everything in there. And then Harry Pearson is probably only for the very brave. This was one from June 2014. It was a very lengthy question. It was a purchase ledger control account, had everything in there, errors, adjustments, a reconciliation to do. Some of the errors were to do with the control account, some of them were to do with the individual accounts, and it was quite horrendous. So if I'm feeling brave, I might have a go at tackling that one. But anyway, I hope you've enjoyed this basic video on control accounts, and hopefully I'll see you again soon. Don't forget to like and subscribe. Thanks for watching.